Good evening. Welcome to the solution for the pension question that I've given you in class. My name is Steve Janz, and we're going to go over how to solve the pension question. So this video is going to be a little long, and bear with me. I'll probably make a couple mistakes, but what I want to do is I want to go through how to create the worksheet to solve the ending balances so you can create the pension journal entry. And I'll go through and I'll discuss the number of things to pay close attention to when you are doing this, just like I did in class. But here, watching the YouTube video, you can go at your own pace. You've had a chance to look at the question. Hopefully you've had a chance to work on it. Maybe you're struggling with a couple little areas, how to do things. For example, net interest cost is challenging. So I'm going to go through this video with you right now and this question, and we will hopefully be able to improve your grade and your mark on the quizzes and in the final for this course. Are you ready? Let's get started. Here's our opening balances. And with most companies, they're not going to be equal. In most companies in Canada, the United States, there is a shortfall. So when you see the accrued benefit obligation and you see the plan assets, what you see is a difference. There's a shortfall here. And that shortfall creates a liability. So the difference between these two is our starting figure right here. $3,260,000 credit. That means that we have a shortfall. So credit, in this case, we're thinking of it as a liability. Now, as I explained to you in class, we're going to break this worksheet down basically into two parts. And you can see I've even got the dotted line here. And over here, these are the items that are going to help us do the journal entry. These are going to be, in many ways, our ending balance sheet amounts. Now, other than our opening balances, what we have to remember is that when we are putting in the numbers here, debits must equal credits. And we're going to use the debit-credit system. We're not going to use plus-minuses. Plus-minuses is not as good. We want to think and talk like accountants. Debit-credit is the way to go. So remember, the first opening balance, they are not going to balance on a debit-credit perspective. The difference between here on the balance sheet is our shortfall. It's our starting amount. And many, many companies have that problem. It's a big, big issue. Now, going forward, debits must equal credits. And that's absolutely key. So as I've said in class many times, we're accountants. And what is an accountant? An accountant is a storyteller. And that's what we're doing here. Is we're putting these numbers together. And we like puzzles. Really, it's just a puzzle. And if we think our way through this, we'll know and we'll understand how to generate the numbers and where to put the numbers. So let's look at our question, our Hoover. And let's look at this and start off by looking at the data that has been given to us. So our current year service cost is $427,250. So current year cost, $427,250 on the debit side, because this column here is about recording our expense for the year. So expenses are debits. But again, where we have a debit, we must have a credit. The credit will go over here under our obligations, $427,250 under the credit side. And that's what we're going to do, back and forth. So most of these rows are worth 1, 2 marks. The net interest cost is usually worth about 4 marks. And we just have to know where to put this. Now, as I said to you in class, is that you have to get the entire row correct. So if you put this in the right spot, but you put this number in the wrong spot, you don't earn the mark. You ought to get each row right, except for the net interest cost. That one's a little different because that one's tricky. Let's carry on with the next number. Past service cost of $775,000. So what we're going to do is we're going to expense all of that right off the bat, and we're going to also put that into our obligation here. Now, a past service cost, what is that again? Well, basically, what happens is that companies, when they start, they don't often start with a pension plan. They're just trying to survive. So years and years go by and they could become successful. And the next thing you know is they go, well, how are we going to support our employees when they retire? So they negotiate with the employees and they set up these past service cost amounts. They basically fund the start of pensions for employees so that when some of these senior employees retire, there is something there for them. But obviously, when you've been in business for years and you start this and you have a number of employees, you're looking at a pretty big amount for your first year of starting this and getting it going. Let's go on to our next number. It tells us that employer contributions for the year were $900,000. So contributions means that the company has paid cash. And who do they pay the cash to? They pay that cash to a trustee, someone independent of the company who will look after that money, hopefully generate some good earnings in a secure manner. But the company does not have the rights to go in and touch that money. Those are the rules in Canada. We don't want that. So it's going to a trustee. So $900,000 of cash coming out of the company. Remember, we're doing the company's journal entry here. And then where does it go? It goes into the assets for the company and for the pension plan. So this goes into the pension plan assets, $900,000. And again, credits must equal debits. Our next number, benefits paid to retirees. So the pension plan right over here is designed to pay retirees. So we're going to have monies coming out of our assets. And again, these assets, even though the company has put them in, these assets are controlled by a trustee. So these assets here, these assets designed for the employee, paid by the trustee. And of course, if you pay that obligation down, then you obviously reduce your obligation. So if you're reducing your obligation, that's a debit. So we know that setting up a liability as a credit, paying it down as the opposite, that is a debit. Now, it tells us that our actual return on assets was 8%. That's a good return. We like that. So over here, I'm going to create a schedule of how we're going to calculate this row here, the net interest cost. So our first number is the return on assets. So 8% times our starting amount of $10,990,000. And that will equal $879,200. So as we swing over here, we're going to be able to enter in that value over here, because what we're saying is that our assets are going to grow over time. Now, as I mentioned in class, that pension plans are huge. There's many large pension plans across Canada. And if you ever wondered who owned a lot of the high-rise buildings in your downtown, who owns a lot of the shopping malls in your community, a lot of them are controlled by pension plans. And who has a lot of the stock market? Again, pension plans. I often joke, who once upon a time was the largest shareholder of the Toronto Maple Leafs? A pension plan. Now, what we also take a look at here is the discount rate. This is the rate that we basically are going to have. That is our charge, our time value of money charge. So if we owe $1 today, we know that 20 years from now, that might be the equivalent of $3 or $4. So we have to grow that money. So this is the charge, the time value of money. As money loses its value over time, we therefore have to boost up our amounts that we owe so that we can have the proper amount in the time that we actually pay it. The time value of money principle. So you can see here is that we have a discount rate of 5%. So our actual return was $879,200. And this 5% basically is an ability for us to reduce our interest charge. So again, we gain money on our assets, but we also, in a lot of ways, in theory, lose money because our obligations are going to be paid many years from now. So 5% times 10,990,000 is equal to 549,500. Now, when you look at these numbers, this is a good thing, because generally speaking, we actually gained more than we thought we would actually have a charge against us. So the net result here is a gain, 329,700. So this is a remeasurement gain. So in the last few years, it's 2014 now, the stock market has done really well. And a lot of companies have really seen some nice gains. So for a lot of pension companies, they're starting to report some nice positive remeasurement gains. Now, where do we place that? Where do we put that number? Well, right over here, we've got a separate column for remeasurement gains and losses. Now, think of this along the lines of an income statement. So revenue gains are credits. Losses, expenses, are debits. So this is a gain. So 329,700 credit. So think of this column here as an income statement type column. Just as this is an expense column, think of this as an income statement one. So this is, we'll consider this a gain, just like we consider revenues, and those are credits. So we've got some of the calculations done. We've got 2 out of the 4 numbers done. Let's do the other 2 numbers. And again, this is the tricky row. Down here, here's what we have to do. We've got an interest cost. So this is the cost with regards to our obligation. This is the cost that basically looks at the fact that if we owe, and we believe we owe $14,250,000 today, that number is going to have to increase because of the time value of money. And we've set up a discount rate of 5%. So how do we do this calculation? Now this one's tricky because our opening balance is $14,250,000. But there's a plus to that, because at the beginning of the year, what happened? We had a past service cost that started when? January 1st of the year. So what we have to do is we have to add that $775,000 to our opening balance. And when we add that opening balance amount of $775,000, multiply it by that discount rate of 5%, we then get $751,250 credit. So we are growing our obligation. So over here now, what we're going to do is we're going to add this to our benefit obligation here, $751,250. Now, we're almost there. And remember, debits must equal credits. We're missing one more figure. So let's move over here and we'll calculate it. It's the net interest cost. This number here we're missing. Now, what is this? What is this number? Well, what this number represents is that at the beginning of the year, we had a shortfall. And that shortfall has to be accounted for. And we need to put in an expense for that amount. So let's take a look here at our net interest cost. Oops, I think I just made a mistake. So I'm going to correct that right now. This net interest cost here should actually be accrued benefit obligation. This is actually the expense. Darn. Oh well, let's carry on. So the expense, how does it work? Our opening shortfall was $3,260,000. But again, our shortfall is not $3,260,000 anymore because we had that past service cost. So we now have that past service cost of $775,000 that we have to account for. Multiply that by 5%, And you will have a value then of $201,750. And this is an expense. That is a debit amount. So we'll put that in here, $201,750 debit. And voila, it will now balance. And you can, as I've just shown you, calculate all four of those numbers. Now, we have one more number to calculate. What happens is that we do all these calculations, and we take a look at what the balances are. Now, who does and who gives us a lot of this information? Is it the accountants? No. The accountants organize this and put it together. But there is a profession out there of actuaries. They are specialists in estimating future events, telling us what type of discounts to rates to use. And a lot of it is that calculus that is really challenging for a lot of us in university. Now, every once in a while, an actuary goes through everything and in some ways uses balance sheet accounting and says, this is what I come up with as your true obligation. Now, you may not have that number, but you need to, at the end of the year, show that as your number. So that means we need to do an adjustment. Again, this is balance sheet accounting. So what the question is saying is that the accrued benefit obligation balance needs to be $15,825,000. And that needs to be a credit. Now, we're not there. We actually have to take a look at this and say, we add all these up together, add these up, of course, and subtract that one out. And what you'll actually see is that we're, in this case, a little higher, which is a good thing. So what we do is we make one more adjustment here called an actuarial gain. Sometimes it's losses, but in this question, it's a gain. And to make this work, we need to put $126,500 in here as a debit. Now, again, I'll repeat it again. Debits must equal credits. So this is a gain. So where do we put remeasurement gains and losses? Right here. So $126,500 as a credit. And there you have it. That is the completion of your worksheet. I've talked about how to come up with all the numbers. Now what you need to do is total everything up and do the journal entry. You have that in your solutions. It's not that difficult. I know you can do it on your own. So overall, I hope this helped you, and have a good day. Thank you.